Hello, I'm Annabel Brady-Smith, Communications Director of the Association of Investment Companies. Elections, trade wars, Brexit uncertainty, and of course, most importantly, coronavirus have made 2020 a year like no other. Year to date, the FTSE All-Share is down 9%. However, the average investment company is up 11%. And up an even more impressive 51% since the market low on 23rd March. Despite the obvious concerns, there continues to be a healthy amount of secondary fundraising, and the industry has seen 6 new IPOs, raising $855 million. The industry's assets also reached a record high this year, quite an achievement considering the challenges it has faced. To discuss the past year and their outlook for the year ahead, I'm delighted to be joined by Jade, Manager of City of London Investment Trust, Simon Barnard, Co-Manager of Smithson Investment Trust, and Charles Plowden, Manager of Monk's Investment Trust. Right, on to the questions. What have been the winners and losers in your portfolio during the pandemic? And I'd like to ask that question to Charles.
Thanks, Annabelle. Our top 10 over the 12 months to the end of October were overwhelmingly from the new economy, led by Tesla, which was our best performer, but also with a very strong Asian e-commerce contribution from companies like Meituan, Alibaba, Sea, which is from Indonesia, and Japan's M3. Interestingly, Amazon and Alibaba, though, were the only mega platforms in the top 10, supporting our view that some of the younger companies, what we might call second generation platforms, are even more attractive than the giants. So Shopify and Sea are typical, and luxury goods platform Farfetch was also up there. Predictably, among the biggest losers were a Brazilian and an Indian bank, and we did sell the former, and a couple of energy related companies. But the biggest disappointment was Prudential of the UK, which we've held for many years for its exposure to the long-term growth in Asian savings. And while direct sales by the Pru were impacted by lockdown, and especially when they closed the border between China and Hong Kong, we would have expected the market to look through this short-term hiatus and to focus on the longer-term opportunity. So we remain fully committed to the Pru and see it as one of the most attractive stocks globally.
Thank you so much, Charles. Honestly, some of those platforms really have transformed our lives during this year. Simon, what have been the winners and losers in your portfolio during the pandemic?
Well, it probably won't surprise you to learn that several of our top performers were in the healthcare space. So our top performer overall was Ambu. This is a Danish healthcare company that makes disposable endoscopes. Now, endoscopes being, of course, the technical items that doctors use to look inside patients. Now, most endoscopes are reusable. That is, they're used on over 200 people before they're changed. They are, of course, cleaned in between procedures, but not always perfectly. So actually, there's been a rising incidence of infection. And that has obviously been a major problem during COVID, because you were seeing non-COVID patients actually catching COVID from endoscopes, which had been used on prior COVID patients. And also the people cleaning the endoscopes were also catching COVID. So what they discovered was that by using disposable endoscopes, which you just use once and then recycle, you can completely cut out this possibility of infection. Now, with Ambu being by far the largest producer of disposable endoscopes, they significantly benefited over this period with their demand up 70%, that's 70%. We also had a healthcare company in the US called Masimo. They make sensors, and they're normally deployed into intensive care units. So as those intensive care units grew, so too did their sales. They also produce sensors which they were able to attach to patients who they could then monitor remotely. So patients could either wander around the hospital or even better, go home and save hospital beds. That too proved very popular, pushing up Masimo's share price. And finally, we had a healthcare company based in New Zealand called Fisher & Paykel Healthcare. They make respiratory equipment, which was obviously in very high demand. In fact, so much so that Fisher & Paykel had to delay their full year results in 2020, simply because there were so many people within the company manning the phones to customers or on the manufacturing production line that there was simply no one left to do the reporting, to put out the annual report, which we found quite impressive. We also had good performers among some consumer companies, in particular Domino's Pizza, which we own the franchise in Australia. They also have a couple of European markets, and they benefited a lot from this stay-at-home trend, as well as a lot of the competing restaurants, of course, being closed during lockdown. Now, in terms of detractors, the companies that really hurt our performance, we only had a couple. By far the worst performer in our portfolio was a company called Sabre. This is a US software company that is related to the travel industry. They connect travel suppliers like airlines and hotels to travel buyers like travel agents and consumer websites such as Expedia. Now, their revenue is directly linked to passengers boarded on planes or booked into hotels. So as passengers fell over 90% at the peak of the crisis, so too did their revenue. Now, unfortunately, this is one of the very few companies we own that actually has any debt, perfectly manageable in a normal operating environment. But of course, if your revenue falls 90%, pretty much any debt is going to be a problem. Now, we were very concerned about this company and did an intense amount of work on it in a very short period of time. I remember even waking up at 3 a.m. thinking about this company. But what happened was that the management team managed to very quickly cut costs within the business, as well as return to debt markets to raise over $1 billion of debt capital and $500 million of equity capital, which enabled them to provide enough liquidity for that company to survive with almost no revenue for the next 2 years. And after that was done, we felt a lot more confident holding that company. In fact, we added to it quite close to the lows, and it has since recovered. Another company that didn't do too well during the crisis, which is one that many will have heard of, is Fever Tree Drinks. This, of course, did poorly because with bars and restaurants closed, people were worried that they wouldn't be able to sell much tonic. Actually, half of their business is done through what we call off-trade, which is supermarkets and grocery stores. And actually, that almost went up to compensate. So we discovered that although Fever Tree, the share price did perform quite poorly for a short period of time, it's now actually beyond where it was in January, February, simply because tonic sales have recovered very quickly.
Thanks so much, Simon. Pizzas and healthcare, what you needed in the pandemic. I have to say, I might have bought some of those bottles of tonic from Fever Tree during lockdown. Jade, what have been the winners and losers in your portfolio during the pandemic?
Well, the consumer staples sector has been a winner through the pandemic. And these consumer staples I define as makers and sellers of essential goods. And to really highlight two stocks which City London owns within that category, Reckitt Benckiser, which has a big health and cleaning division. I mean, they make Dettol, and many households, including my own across the country, have been spending a lot more on Dettol wipes and sprays. And, they've really benefited. And also within consumer staples are the sellers of essential products like the supermarkets, and certainly Tesco's and Morrison's, which we own in City London, have both done well, and they're now paying back their business rates relief, and they've carried on paying their dividends. And there's been a trend away from the discounters relatively, and more as people do one big shop, more back to the big supermarket groups. And in addition, the big supermarket groups have got their home delivery sorted and are much more competitive now on that. So that's been the good area. The worst area really has been travel and leisure. I mean, they've been at the absolute eye of the storm. We've had to reduce our exposure. And unfortunately, I do think dividends will take a long time to return because with social distancing, the recovery is going to be slow in the travel and leisure sector. And in addition, many of the companies have taken a lot of money from the government, which they needed, the furlough scheme and various loans, etc. And as a result, they have to repay all that before they can start paying dividends again. So sadly, I think that's going to be a sector which will be quite slow to recover.
Thank you so much, Jade. Yes, I can understand those supermarkets. There was many visits in our household during lockdown. Moving on, Jade, what's your outlook for income in the UK as you approach your 55th year of dividend increases?
Yes, well, this has been the toughest year for income in my career at the stock market. It began in 1983. And I think there are kind of three categories of dividend cut. I mean, almost half FTSE 100 companies either cut, omitted, or cancelled their dividends in the first half of the year. And I mean, there were companies which was just a question of survival, like travel and leisure or retailers which couldn't be open. And so they obviously had no option but to stop paying a dividend. So other companies where for social reasons, maybe their suppliers were having government support, they didn't, or PR reasons, they didn't want to pay a dividend. I would categorize BA Systems and Direct Line as examples of that. And then were companies who perhaps for quite a few years have been over-distributing their dividend, and under the cloud of the crisis was sort of golden opportunity to reset. And the oil companies would be examples of that, Royal Dutch Shell and BP. Really difficult time in the first half of the year, much better since, the autumn and beyond. A lot of those companies which didn't pay for social reasons, like BA Systems and Direct Line, which we hold in City London, back on the dividend list. We've had special dividends which weren't paid, being paid again, like from Sabre Insurance or Morrison's just recently. Much better. And those companies that reset, there's a sign that they've actually sort of found a base on their dividends. And, Shell is an example where they actually have increased the quarterly dividend, from the new, much lower levels. So I think I'm very confident that we're definitely through the worst on dividends and that the market can resume its normal dividend growth.
I think we can all understand it's been the most difficult year of your career, and you have been managing the City of London since 1991. The good news that it's more positive going forward. Charles, what themes in Monk's portfolio are you most excited about at the moment?
Well, apart from the Asian savings companies, which I mentioned earlier, and in addition to Pru, we also own AIA and Ping An. I think there's three broad themes. So the first is some of the more focused internet platforms and services. So the first round of the internet applications were consumer focused. They were social networks, advertising based, e-commerce companies. But the current wave is more subscription based services, taking costs and complexity out of the system. They're often built specifically for the cloud and to best generate and use data. A lot of these are certainly newer companies showing very strong growth rates, and names would include Teladoc and Ping An Good Doctor, both of which are telemedicine companies, Farfetch, which is a luxury goods retail e-commerce, Chegg in education, Adyen in payments, and a smattering of cloud-first enterprise software companies, including Cloudflare, Datadog, and Snowflake. They all have very exotic names. So that's the first category. The second theme is what we call the eye of the storm. And there are some recovery stocks that we have been buying through the summer. Industries which are feeling very severe stress at the moment, but where we do expect more normal demand to return. And in particular, two leisure travel companies, Bookings and Ryanair, who should both be share gainers because of financial and operational strengths. Combined actually with the severe weakness of many of their competitors. So in fact, Ryanair is in the process of adding 200 new airplanes to its fleet at the same time as its major competitors are permanently cutting their capacity by between 15 and 20%. And then there's CBRE in real estate, because we don't expect offices to become entirely redundant. And even Lyft, which is the more focused US competitor to Uber in ride sharing, who have some very interesting longer-term growth options. So eye of the storm stocks is a recovery theme. And then lastly, and probably controversially, I'd cite an enthusiasm for the very unfashionable mining majors. So we have recently bought into Rio Tinto and also added to BHP, anticipating a likely tighter markets in metals after 8 years of very muted capital investment across the sector. Because cash flows were used firstly to pay off very large debts, and since then they've been dedicated to dividends, and there's been minimal levels of spending on production, which is beginning to lead to supply shortages already, which is amazing when you think about it, even in a pandemic. Now, you analysts here are unanimous in predicting lower prices, lower metals prices, and lower profits. But we're not so sure, and we expect a useful boost to come to demand from plans to build back better. And what is clear to us is that our hypothesis of strong pricing is most definitely not reflected in current valuations. So these companies bring a very different type of risk and opportunity to our portfolios. So we've got three categories: data-driven growth stories, sure bet recovery plays, and then a slightly off-piste exposure to a very unfashionable mining sector.
Thank you very much, Charles. As I think we've really got a good idea of the diversity of your portfolio, but also those key themes and where you're focused. Simon, what global smaller companies offer investors today, which large companies aren't?
Well, I think, first of all, small caps are offering what they always offer in terms of advantage, which is that they have, over time, a faster compound growth. And now that's really because they, of course, are starting from a smaller base, whereas large companies suffer from a law of large numbers, or another way of saying trees can't grow to the sky, because every year they've got to pound such an enormous number of new customers or revenue streams just to keep that revenue growth going. Small companies don't have that problem for many, many years. In fact, that's probably why small caps tend to outperform large caps over time. Over the last 20 years, up to 2019, small caps in our space, which is the global space, actually generated double the performance of large caps over that period. But more interestingly today, it's been noticed that small caps have actually underperformed large caps since the beginning of 2019. And that has actually started to change in September, and small caps got even more of a boost since the vaccines were announced at the beginning of November. And now clearly this doesn't tell us anything about the future, but I think it is an interesting development, and it's potentially because people tend to buy small caps when we're coming into an economic recovery, because they tend to be more pro-cyclical, simply because they're less diversified and more reliant on external funding. But I think it's an interesting observation in the present moment.
Excellent. Well, let's hope it's positive for small caps, therefore, going forward. I'd like to ask all our managers, where are you seeing opportunities and risks in 2021 and beyond? And I'd like to start with Jade, please.
Yes, in terms of opportunities, I think the UK market is quite interesting at the moment. It's underperformed world markets quite significantly over the last 10 years, and that pace of underperformance became more rapid after the 2016 referendum. And I think it has been shunned a bit by global investors, even though our large companies are FTSE 100 index is very global. But I think people, in surveys of fund managers, people have been very reluctant to put money into the UK. Of course, we don't have, by any means, the number of great growth stocks you can find in the US market and some of the other markets. So, that is a factor. But even if you compare our companies in their sectors with overseas companies, we are cheap. And that was well illustrated in November by the bid for RSA, an insurance company. And this was bid for by a combination of a Canadian and Scandinavian insurance company. And they're both paying for RSA by issuing much more highly rated paper. They're much more highly rated in their home markets. So, I think the UK, could be an interesting opportunity over the next 12 months. And then risks, I think people have been sort of paying up for growth, I think, and it's been well rewarded. I think, obviously growth as a theme has been really dominant. But sometimes these trends don't last forever. And I think the sort of valuations in some parts of the market are very high. I mean, when you've got ultra low interest rates as we got at the moment with very low 10-year and longer bond yields, I mean, it is quite supportive of that. But if that kind of backdrop was to change, I think, some big profits in some of these stocks. And I think there is a vulnerability there, in my opinion.
Thank you very much, Jade. I really hope you're right. In the UK is an interesting opportunity in the next 12 months. Simon, where are you seeing opportunities and risks in 2021 and beyond?
Well, I think clearly with the threat of the coronavirus receding, there are going to be a lot of benefits to those industries that have suffered greatly, including travel and leisure. So I think that as that occurs, that could provide a boost to a lot of those industries. But I would caution that I don't think it's going to be a smooth path. I think there are going to be a lot of bumps in the road to recovery, simply because the logistical scale of trying to give vaccines to billions of people, some of which, in terms of vaccines, are very difficult to store and transport, and also in terms of the people, many of which don't even want it. So I think it's not going to be smooth sailing, and I think that there will be moments of uncertainty, which we all know the market doesn't like. So when we see that, I think we will see volatility along the way. But generally, I think the trend will be positive over the next couple of years for some of those industries that have suffered in 2020. Second, I think the new Democratic administration in the US could prove to be very interesting. What we tend to find through history is that new Democratic administrations tend to lead to strong equity markets in their first year. I wouldn't necessarily say that that's going to happen this time, simply because it tends to follow a lower year for equities when the Democratic president is actually elected, which we haven't had this year. It's been a strong market with the S&P 500 up 15% this year. But the history tells us that it tends to be okay in the first year of a Democratic administration. So we'll see if that plays out again this time. And then in terms of risks, I think we shouldn't forget that a lot of asset prices have been driven by the global coordinated monetary policy that we've seen from central banks and the unprecedented expansion of balance sheets through QE. And I think that any moderation or change in that will affect asset prices globally, not just the equity market, but certainly will have a meaningful effect on the equity market.
Thank you very much, Simon. I certainly hope you're right about travel and leisure. I would like to get back to normal again and actually have some fun. Charles, where are you seeing opportunities in risk next year and beyond?
Well, Annabelle, I hope you'll forgive me if I'm slightly irritating and take gentle issue with the question. First, because I always try and think ahead 5 years or more rather than focus on the short term. So I honestly admit that I wouldn't be much good at 2021 predictions. And secondly, because I think investors tend to spend far too much time and energy worrying about the risks and not enough about the opportunities. And the great thing, of course, about equities is the asymmetry which they offer. You can only lose 1 times your investment, but you can make many, many multiples on that investment if things go right. So we try to see the opportunities everywhere across industries and across markets. And of course, the joy of a global mandate is this ability to go anywhere. So I see the opportunity to double our money in pretty much every stock in the Monk's portfolio over the next 5 years. And if we conclude that the odds of that happening fall below 1/3 for whatever reason, then we will sell it and move on.
Well, Charles, I really hope you're right. I like your optimism and I like the fact you're looking for opportunities. I'd like to thank our managers very much for joining us today. It's great to hear their views on the pandemic and the outlook for 2021 and beyond. But I'd like to emphasise we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. All that remains is for me to wish you a very Merry Christmas and a Happy New Year. Thanks so much for watching.